Let me ask you a question. Your investment portfolio grew 7% last year. You check your statement, you see the number, and you feel good. But did your money actually grow? I mean, really grow, in terms of what you can actually buy with it. If you're not asking that question, you're missing half the story. And that missing half could cost you hundreds of thousands of dollars over your lifetime. Welcome back to Wealth Unlocked. I'm James, and today we're talking about the silent tax that nobody puts on your brokerage statement. The one that quietly eats away at your compound interest year after year. I'm talking about inflation, and more specifically, the gap between what your investments say they earned and what they actually earned in real purchasing power. Let's start with a simple example. You invest $10,000. Over 30 years, it grows at 7% annually. Your statement at the end shows $76,123. That looks great, right? You turn $10,000 into over $76,000. A 7.6 times return. But here's the catch. If inflation averaged 3% over those 30 years, which is roughly the historical average, that $76,000 only has the purchasing power of about $31,000 in today's money. You didn't multiply your wealth by 7.6. You multiplied it by about 3.1. Now, tripling your money over 30 years is still respectable. But it's a very different story from the headline number. And if you're planning your retirement around the headline number, you're in for a nasty surprise. This is the difference between nominal returns and real returns. Nominal is what your statement shows. Real is what you can actually buy with it. And the gap between them is inflation. The S&P 500 has delivered about 10.2% annualized return since 1926. That's the nominal number everyone quotes. But after adjusting for the roughly 3% average inflation over that period, the real return drops to about 7.1%. Still excellent. But nearly a third of your headline return was just keeping up with rising prices. Here's where it gets interesting. The simple way to calculate real returns is just to subtract inflation from your nominal return. 7% minus 3% equals 4%. Easy, right? But that approximation starts to break down when inflation is high. The precise formula is called the Fisher equation. It goes like this: real return equals 1 plus the nominal return divided by 1 plus the inflation rate, minus 1. So for 7% nominal and 3% inflation, it's 1.07 divided by 1.03, minus 1, which gives you 3.88%. Not 4%. The difference seems small, just 0.12 percentage points. But over 30 years, that tiny gap compounds into thousands of dollars. And when inflation is higher, the error gets bigger. If your investment returns 10% but inflation is 8%, the simple subtraction says you earned 2%. The Fisher equation says 1.85%. The gap is bigger, and it compounds. Let me give you a real-world example. In 2026, the consumer price index is running at about 4.2%, a 3-year high. The Federal Reserve has held rates at 3.5 to 3.75% since June. If your high-yield savings account is paying 4.5%, your nominal return looks decent. But after 4.2% inflation, your real return is just 0.29% using the Fisher equation. On a $20,000 emergency fund, that's about $58 in real growth for the year. Your statement will show $900 in interest. But your purchasing power only went up by $58. Now imagine that same $20,000 sitting in a regular savings account at the national average of 0.46%. After 4.2% inflation, your real return is negative 3.6%. You're losing about $720 in purchasing power every single year. And you don't see it on your statement. That's the silent tax. Now, here's the part that really stings. You pay taxes on nominal gains, not real gains. So the government taxes you on the part of your return that only kept up with inflation. Let's say you earn 7% nominal, inflation is 3%, and your long-term capital gains rate is 15%. Your after-tax nominal return is 7% minus 15% of 7%, which is 5.95%. But your after-tax real return, the number that actually matters, is about 3.7%. Less than half the headline 7%. This is why the most dangerous place for your long-term money is cash. The national average savings account pays 0.46%. With inflation at 3%, you're losing about 2.5% of your purchasing power every single year. Even a high-yield savings account at 4.5%, after 24% federal tax and 3% inflation, gives you a real after-tax return of about 0.42%. You're barely treading water. So what do you do about it? First, think in real terms. When you project your retirement savings, use a real return, not a nominal one. If you expect 7% nominal and 3% inflation, plan using 4%. That automatically accounts for inflation and gives you a much more honest picture of your future purchasing power. Second, own assets that have historically beaten inflation. Stocks are the best long-term inflation hedge for most people. The S&P 500 has delivered about 7% real returns over the long run. Bonds give you about 2.4% real. Cash gives you basically zero. The longer your time horizon, the more you should tilt toward equities. Third, use tax-advantaged accounts. A Roth IRA lets your money grow tax-free. You never pay taxes on the gains, which means inflation is the only drag on your real return. A traditional 401k defers taxes, which means more money compounds before the tax man takes his cut. An HSA is the holy grail, triple tax-free if you use it for healthcare. Every dollar of tax drag you eliminate is a dollar that stays invested and compounds. Fourth, consider Treasury inflation-protected securities, or TIPS. These are bonds whose principal adjusts with the consumer price index. They guarantee a real return above inflation. As of mid-2026, 10-year TIPS yield about 1.9% real. That's not exciting, but it's guaranteed. For the portion of your portfolio that needs to be safe, TIPS are far better than cash. Fifth, and this is the most important one, stay invested. The biggest mistake investors make during high inflation is panic selling into cash. In 2022, when inflation hit 9%, many investors sold stocks and moved to cash. They locked in losses and missed the 26% rebound in 2023. Vanguard's research shows that investors who maintained contributions during the 2022 bear market were up 37% by 2025, while those who stopped were up only 14%. Here's the thing about inflation and compound interest. They're both exponential. Inflation compounds against you, eating away at your purchasing power. Compound interest works for you, building your wealth over time. The winner of this battle is determined by two things, your time horizon and your behavior. Over short periods, inflation can win. In 2022, the S&P 500 lost 18% while inflation hit 9%. That's a brutal combination. But over any 20-year period in modern market history, stocks have beaten inflation. The real return over every single rolling 20-year period since 1926 has been positive. The rule of 72 tells us that at 3% inflation, prices double every 24 years. A retiree who needs $50,000 a year today will need about $100,000 in 24 years to maintain the same lifestyle. That's why you can't just save, you have to invest. But here's the good news. The same rule of 72 works in your favor. At a 7% real return, your purchasing power doubles every 10 years. That's $31,000 in real terms from our earlier example. Leave it for another 10 years at 7% real, and it becomes $62,000. Another 10 years, $124,000. That's the power of compound interest working in real terms. The goal isn't to beat inflation every single year. Some years you will, some years you won't. The goal is to stay ahead over decades. And the data is clear, a diversified portfolio of low-cost index funds, held for the long term, has consistently delivered positive real returns. So next time you check your brokerage statement and see that 7% gain, ask yourself the real question. Not how much did my account go up, but how much more can I actually buy with this money? That's the number that matters. That's your real return. And that's what compound interest looks like when you strip away the inflation illusion. Thanks for watching. If this episode made you think differently about your investment returns, hit subscribe. We release new episodes every Monday, Wednesday, and Friday to help you build real wealth in real terms. I'm James, and this is Wealth Unlocked.